I recently surveyed on Twitter and on Facebook, what is the single worst piece of advice that you've ever heard anywhere about trading? And I'd like to share the top 8 most common responses with you right now so that way you can avoid them. The first piece of bad advice is don't use stop losses. Somebody submitted this and their broker told them don't use stop losses, and it ended up being a disaster. Now, I know that a lot of you watching this are probably like, I don't use stop losses and I haven't had problems, but I think that the main point is that you need to have a plan on how you will exit a trade and be able to execute that plan. And stop losses are a tool that will help you execute that plan, especially if you're somebody that's not dialed into the market all day long. If you're not in front of your computer 100% of the time, a stop loss will help protect you from taking on a loss that is potentially much greater than you had anticipated. That's the main purpose of the stop loss. What we really need to also have is a plan that if we don't have a hard stop, we still have to know exactly what point we will exit a trade if the stock moves against us. We don't want to wait until the stock actually starts moving against us and then try to figure it out on the fly and just go by whatever we happen to feel in that moment. We need to be able to execute and execute immediately when we see something that is moving against us, and we need to know what to do. A trading plan will help us with that, and it's because we've already taken the time to figure out how we will respond and why we will respond in the way that we're going to do. We'll have a set of rules, a set of signals, we'll have all that mapped out, and we will have a plan that will help us execute based on those signals and rules and whatever other systems we have. The actual physical stop loss with the broker, that's just a way to help execute that plan. So long as you're able to execute your plan, you're good. But the key thing is have a trading plan and be able to execute your trading plan. Bad piece of advice number 2. Don't sell. It dropped way too much. Wait for it to bounce back. Well, what happens if it doesn't bounce back? There are so many stocks in the market that have never come back to their high or to even their IPO price. And you could be waiting for years if you don't sell and you're just waiting for it to get back to the price where you bought it. I have a friend that, well, when we first started trading and we were trading together, one of the things that we both bought was Citigroup. And that was back when the banks were too big to fail. And so we bought that, and of course, all the banks started to come down and come down and come down, and it just stayed down for a very, very, very long time. And I ended up exiting relatively quickly. I think that I probably took about somewhere in the neighborhood of a 5 to 10% haircut on that particular trade. But unfortunately for my friend, he ended up sitting there with that loss and watched that 5-10% turn into a 15 to a 20 to a 30 to a 40. I think that he got all the way down to a 50% loss, and he was sitting with that trade for years. And I think that finally, after about 2.5 to 3 years, it finally did climb back up and he was able to get out pretty close to break even. But to have opportunity cost for 3 whole years, that's a long time. And so the main theme that we need to think about here is that we don't want to just hold on because a stock is way too low to finally sell. We need to think about both the paper loss that our account is reflecting, and we also want to think about the opportunity cost of holding this stock that is down so much and isn't going anywhere, what that opportunity cost is going to be when there are many, many, many other ideas in the market that could potentially be moving a lot faster, a lot quicker, and help us get back to even a lot faster, rather than just sitting and waiting and hoping that our stock returns to where it was. This one's hilarious. If Trump wins, sell everything. No, it really doesn't matter if Trump wins, if Obama wins, or whoever is in political office. It doesn't matter. None of that matters. Well, what matters is what stocks are doing, what the market is doing, and how those things are behaving, irrespective of everything else. We can always point to the market is moving this way because of that. Well, there's a million different variables that caused that to happen. We don't really know what they are. We can try to rationalize what they are. We could try to analyze and think through what they might be. But by the time we finally do all that, probably moved again, and there's other things that are constantly coming into the market and influencing price as well. So the thing that we really want to pay attention to isn't the news, isn't who's in office or who's not in office or who won which election. What we want to pay attention to is the one thing that really matters: price. That's it. Price is already taking into account everything that is feeding into it, and so all we have to do is just watch price, and that's going to tell us which way things are ultimately trending, if things are trending higher, if things are trending lower, which time frames things are trending higher or lower on, and that is how we can really win in the market. Bad piece of advice number 4, and this is one that I see all over social media, and it is others predicting and trying to boost their own confidence by getting others to buy into their opinions. So the way that you'll see that is when you see people spamming a message board and saying that this is a great stock, you should buy it here, it's going to go lower, but get in now. Oh, see, look, it just started to climb higher. And then like every single time that X, Y, or Z stock does something, you see these people going in forcefully hard with their opinions. And who are they trying to convince? Are they trying to convince you, or are they trying to convince themselves? So there's a lot of opinions that are out there everywhere in social media, on YouTube, on Facebook, on Twitter, on StockTwits, on anywhere you look, newspapers, on television, they're everywhere. People want to give you their opinions. There's only one opinion that matters. It's the market's. And the way to figure out what the market's opinion is simply by looking at the price chart and seeing which way is price going. Is it going up, down? Is it starting to consolidate? And you can learn how to figure all that stuff out by just being able to analyze the base patterns, and I'm doing a whole separate segment on how to analyze base patterns and figure out which way demand is coming and which way it's flowing in or out, or what's the dominant trend. Bad piece of advice number 5. It's so cheap! Buy it now! It's never a good reason to buy. I think it was Al Rizzo who said, if somebody tells you that something is a screaming buy, try buying it 30% lower. Whatever appears to be cheap now can continue to drop and drop further and further, and we never really know how far something can drop until it actually stops dropping. There's another quote by Jim Cramer, who was saying that he once bought Bethlehem Steel because he thought that it was cheap, and it was the worst trade that he ever made. It was trading at 2 times earnings. How much further could it possibly fall? And it ended up falling to zero. So any stock can continue to fall. It doesn't matter what it is. There is no such thing as it's so cheap, buy it now. You need to weigh other factors. And the ones that I like to look at are price and volume action, looking at the stock charts. You might have other ways, but you don't want to just look at something and say, it's cheap, buy it now. There's a lot of other factors to consider. This is a personal favorite of mine. Technical analysis doesn't work. Buy high, sell higher. Doesn't work. Well, I think that a lot of the people that are profiled in Jack Schwager's Market Wizards book would beg to differ. And it's not just because some of them do buy high, sell higher. It's not because some of them use technical analysis. It's because I've literally seen people that have had extraordinary success in the market have one strategy, and somebody else also have extraordinary success in the market with a complete opposite strategy. The truth is, everything works. What matters is finding the way that's going to work for you, and what's going to work for you is largely going to depend on what your own personal beliefs are and what is going to best fit into your own trading style and your own lifestyle. Bad piece of advice number 7, buy my expensive course. Now, I think that it comes with a few caveats, right? If somebody's coming at you and they're just telling you, buy this, buy that, and they didn't give you any kind of value up front, then how do you know what they're about? How do you know from where they're speaking? How do you know if their product is right for you? How do you know if their course is right for you? There's a lot of questions that you need to think about before you buy anything, before you buy a course, before you buy a product or service or any of these things. Trading isn't like buying a t-shirt. There's going to be a commitment involved, and it's learning how to trade stocks and trade stocks successfully takes a long time. It could take several months, several years to really get your footing and to be able to do this on your own. And there's a lot of different ways that you can accelerate your learning curve. But before you go and just buy somebody's course, you need to know what they're all about and what the course is about, and what kind of success that they've had. And if they aren't giving you any kind of value up front, it makes it real hard to gain a good understanding of what they're about and if it's right for you. So if somebody just comes at you and tells you, buy my course, you need to investigate them a little bit closer to see if it's right for you. Bad piece of advice number 8, this is my personal favorite. It's buy more on the way down. The story hasn't changed. Your reason for buying it hasn't changed. Buy it on the way down. It's just pulling back. It's at a discount. If you go to the store and you see that something is marked 25% off and it's your favorite product, then you will buy more of it. Right? So why wouldn't you do the same thing for the stock? It's on sale, it's pulling back, it's at a discount, just buy more of it. Well, if you buy at 100 and it falls to 95 and you buy more, and then it falls to 75 and you buy even more because you're still right, and then it just keeps on falling. If it doesn't rally back, now all of a sudden you have all this inventory. What you need to think about trading is you need to think about it as you are the business. Not that you're the consumer, but you're the business. And so if your favorite stock is at 100 and you buy it at 100 and then all of a sudden it's at 95, you're not just buying it for your own consumption. You're the one that needs to go and then sell this to somebody else. Now, there are circumstances where it could be pulling back and there could be reasons to buy on a pullback, but you already bought it at 100. So the market is telling you that your initial buy was wrong, right? It's below where you bought it. So why would you go and start increasing your inventory for something that the market is telling you is wrong? And then as it continues to pull down and it's telling you more that you're wrong, you're wrong, you're wrong, sure, price could come back, but what if it doesn't? Then you have all this inventory that you can't move, and the market has already been discounting price, and you can't move this inventory. What you want is price to keep on going up. It should be increasingly hard for you to buy more shares and more shares without paying up, because price keeps on going up. That's supply and demand. So you don't want to buy more on the way down. You want to buy more as price is moving up, and you want to buy more at the right time. And you've already heard me say it, the technical analysis actually does work. Reading charts does work. And consult the stock chart before you make any of these kinds of decisions. And if you need help learning how to read stock charts, there's so many videos on this channel. Check some of those out, or just leave comments down below and let me know what you need help with, and I will get you the help that you need. Thank you all so much for watching. I truly, truly appreciate it. If you have any questions on anything that was said at all, please leave it in the comment section below and I will personally help you. Also, if you think that there should have been a 9, 10, 11, 12 that was not included in this list, leave that down below too, and it will help out everybody else that watches this video to help them avoid some of those other things. If you like this video, click that thumbs up button, that's always helpful, and make sure that you subscribe to the channel so that way you get every single update. Thanks again for watching, and I'll see you again in the next video. Take care, and have a great day.